The US rate decision is timed for 7 p.m. Wednesday, 1st of February. The Federal Reserve is not expected to move, but what accompanying rhetoric could we hear from the statement? Well, joining us now is Charlotte Harington, an asset allocation analyst at Fidelity. Charlotte, welcome. First of all, it's my understanding there's no press conference attached to this. Is that significant necessarily at this meeting?
I think it is relatively significant. So the Fed will, at their press conference meetings, change their economic projections and also their projection for, or their expectation for the path of interest rate rises. And so that press conference really gives them an opportunity to communicate why they've made any changes. So I think there is some significance that this meeting has no press conference.
The communication that you talk about, I mean, back in December, we were fairly well aware after the press conference then that there were going to be 3 interest rate rises this year. Is that your base case? Is that what you are preparing your asset allocation around?
I think we're in the camp of expecting 2 seems very likely, 3 seems possible. And really to get the 3 in, we'd want to see sort of confirmation of that fiscal stimulus and growth, which was solid in the last quarter in 2016, which has continued into 2017. But we'd like to see that that's durable and that even there's an acceleration from here to really get that 3rd hike.
What evidence are you going to want to see then that that is durable? We've got the first quarter earnings upon us now, and there is already evidence that the strong dollar, albeit backloaded last year, is beginning to show some signs of stressing out some of the earnings that we've seen. Now, this is going to continue, obviously, into 2017. That presumably is going to be something that could put a brake on any growth potential.
Well, I think the Fed's really going to be looking at wages as a way to see whether the kind of core inflation is being pushed to the upside. So I think wages are going to be very important against this tight labour market backdrop and also expectations of inflation. So the Fed have talked a lot about people's expectation of the future inflation rate as being very important to their policy changes.
One of the things that's happened, especially since Donald Trump has come to power, his election on the 9th of November, is this big rise in the value of the dollar. Okay, it's pulled back a bit. I think, in fact, if you look at a Fibonacci on this, you're looking at a 50% retracement from the lows that we saw straight out of the gate after the announcement that Trump had won. If you look at the way in which that has moved, does this take some of the expectation out of the Fed, or does it take some of the pressure off the Fed, I should say, to go for 3 rate rises? You're looking at 2. Do you think if we see more dollar strength, we could ultimately see, in fact, the Fed possibly even only managing 1 this year?
Well, that's certainly what we saw in 2016. So in 2016, the Fed were looking at the really quite big appreciation of the dollar that had taken place from 2014 to the beginning of 2015. This time, I think the move since Trump was elected, which has seen the dollar bounce, but most of that has given back. If we look at the year-over-year change in the dollar, it's really not that big. And so at the moment, I don't think that the dollar is going to be something that's going to put the Fed off course. Clearly, if we were to see a significant appreciation and continued appreciation, then that would change that.
What about the horizon for the Fed? I think one of the things I noticed going into the back end of the year that they closed down that horizon. Previously, we'd heard a lot about their worries about raising interest rates in an environment where China perhaps maybe couldn't take the impact of that. There were big question marks about Europe as well last year. But they've closed that down, and their rhetoric now seems all to be about the US economy. Is that just my own naive reading of this, or is that really the reality that's facing the Fed at the moment?
Well, I think the emerging markets have, on fundamentals, improved a little bit. So there's been an enormous amount of stimulus in China over the past year or so, which has been now reflected in better growth data. But the emerging markets are still very fragile, and they are very affected by a stronger dollar and higher yields. So whether that's gone from the agenda for good, we don't know. But for the moment, it has been sidelined slightly.
Okay, let's focus on this rate decision. Anything that you think could be an outlier, a risk to the expectation that could cause the markets to trade either one way or the other?
I think we're really interested to see the statement. So any tweaks to the statements which could potentially indicate that March is a live meeting in terms of raising rates again. It's not our expectation, but we'll be looking to see if there's any clues in there.
Okay, all right, Charlotte, we'll leave it there, but thanks indeed there for joining us. Charlotte Harington there from Fidelity, taking a look at the interest rate decision from the Fed, which is the details are released at 7 p.m. on Wednesday evening UK time.